My work optional account is an investment account, and I've got a target. And one day it's going to hit that target, and I'm going to be less emotionally tied to my business because I've got enough to replace that income, and it's going to make it easier for me to walk away when I want to.
Welcome to the Insurance Refocused podcast, where we're highlighting real agent stories and how they are innovating to respond to the changes and challenges happening in the independent insurance industry. My name's Lindsay, and I can't wait to introduce you to my amazing co-host, who just so happens to be my mom, Carey Wallace. Mom, how you doing today?
Doing well, doing good.
I love this. This is so much fun. I love watching y'all greet each other in the beginning. I love it. I love seeing. So my first podcast show or substantial show was with a couples counselor, family therapist, and I learned from him. So counselors are like super like protective and secretive. So I learned from him how to disclose things very kind of not discreetly, but just kind of be super conscious. I rarely, and if I do, it's super intentional when I mention like family members, right? I've learned that from him.
Mm.
Huh.
So he's like, hey, you're talking publicly. You might not want to talk about, your kids that way. I'm like, oh, I never thought about that, right? I should be very,
Yeah, I get
very
it. I get it.
conscious.
I have really good friends that, when they talk on social media, they use their kids', initials, not their names. And
Yeah.
I totally understand that. But listen, I'd be really hard pressed to do that now since my daughter is sitting on the same podcast with me. So, it is
Well,
what it
she's an
is, right?
adult. She's an adult. So,
Exactly.
Yeah,
so I
it's
love this.
different.
One of the things I love about just the parent. I mean, this is a special relationship, right? In our life, if we think about like our closest relationships, you would say, Carey, you and I are both married, so I would say the primary relationship in our life becomes our marriage relationship, right? And then our relationship with our kids. I'm not gonna say it takes seconds, but your kids grow up, they go on their own, and you're still left with your husband, right? So that's a primary relationship. The relationship with parent and child is special, and I'm fortunate to where I first came into business and I worked in an office right next to my dad. I see my dad every day. I've learned a lot from him. I would listen to him sell and close business, and it totally blew me away. I'm like, my God, how did he get by saying those things? Like, wow, you just learn so much. And when I came into the business, we actually didn't join our agencies until 2004. So I was in the insurance space for 3 years before him and I became one agency, and I started focusing on the life insurance and the investments. Um, but I was incredibly fortunate that he really, oh man, he gave me a lot of like power and authority to make decisions and hiring decisions. And he would push back, he goes, you really think that's a good decision? I'm like, yeah, Dad, I think it's a good decision. I think we should do this. He goes, okay, let's do it. And that's not, in this space, we interact with a lot of, family businesses, and that's not necessarily the common story.
Oh, for sure. I agree. Yeah. It's pretty cool. It's pretty cool though. You're right. These are incredible relationships. Not, if someone would have told me 3 years ago that I would be actually, let's go 4 years ago that I would be sitting doing a podcast with my adult daughter, I would have laughed. I'm like, first of all, she doesn't like insurance. She doesn't really even understand what the heck I do. And I'm not 100% sure she wants to spend that, I don't know. And I'm not sure I want to put a podcast together. And man, it's a super cool way to connect. I was talking to Daniel Sung about the decision to start a podcast. He started a podcast around the same time that I did, and we were comparing and encouraging each other. And we had a conversation about it, and it's one of the best things I ever did. But the reason it's the best for me is because of the cool time I get to spend with Lynn. So it's been a really fun time. So, yeah.
And I think that's y'all aren't business partners per se, but we see this in the agency space. I think this is kind of lead into a little bit about some of the topic that we
Yes.
want to talk about here. It's such a special relationship, and I think it's super important that if you're in business with a family member, is that the lines are drawn very vividly, right? The marcations are very bright to understand the difference in the relationship, and when are we colleagues, and then when are we family? Because if they're not, money has a tendency to really mess things up. You've seen it. I'm sure you've seen it before in some of the transactions that you've been on, transitioning from one owner to a next owner that's family. I early on, I remember a case where the family therapist that I was just talking about, he calls me up and says, "Hey, I got a client. Um, can you come and meet with us and the family?" I'm like, "Sure." So he brings me in as a business owner, and there was this family issue, and ownership structure was jacked up, and the dad who started the company, his health was failing. The son who runs the company didn't have majority ownership, and then the stepmom was all of a sudden almost this guy's business partner because the dad's health was failing, and it was really precarious. And so we had to talk about like that succession, like how do we successfully transition from the dad who owns the majority of the business to the son, and then the stepmom is terrified that she's going to get let. And man, it was complicated. But these are complicated relationships, and money has a tendency to kind of jam it up a little bit.
No doubt about it. So, we've really focused on financial planning at different points within an agency and personal finances, business finances, how they're intertwining. One of the biggest points is thinking about when you're ready to retire and when you're ready to move and allow your agency to become, when you're ready to transition ownership from you either to the next generation, to your partner, or externally, there's a lot of decisions to make in there. And you mentioned a counselor. I actually have a certified valuation analyst or certified CEPA, Certified Exit Planning Advisor designation. And I often say, when I first started my career, I thought finances and lawyer, like if I had a law degree, I would be so much more valuable. In fact, I was sitting to actually sit for my LSATs and actually get a law degree when I was younger. And what I found is what would really serve me well is if I had a psychology degree. There's just no two ways around it. This is all relationships. It really is. But they say in the CEPA program, the agency, so there's um, three parts to the stool. Number one, the business has to be ready for a transition, right? You have to be financially ready for a transition. And you also have to be personally ready to know what you're going to do with your time.
Can you
And
repeat those three things
yeah,
again? Repeat those three things for
so
me.
number one, the business has to be ready. The business has to be transferable, right? You have to get the business ready. The second is you have to be financially ready for you to make a transition. And the third is you have to be emotionally ready and know what you're going to do with your time, because so often the business is part of who you are. They're all your friends, your clients have become you're part of the community. It's so ingrained. So while we're going to talk about the financial part of getting ready for that transition, we can't ignore those other two legs of the stool because they're so critically important, right?
Yeah. 100%. I can't do my job as a financial planner if I don't understand your values, which are so tied to emotions.
Sure.
I mean, there was a day where it's like, oh, I'll invest your money for you, right? But like to me, there's not as much meaning is that, yeah, I want to invest all your money, but I want to make sure more than anything that you're not anxious about your money. You're not anxious about your business. You're not, um, you know, emotionally distraught about something in your finances. I want to make sure that we're addressing those issues. That's why I often say that financial advice isn't prescriptive. There's no like one way to do it. I'll often, I was meeting with a client. It's I do some pro bono work with a nonprofit here in town on financial planning, and this particular individual is a counselor, ironically enough, and she was talking about a lot of her decisions are based off of how she's feeling. And I kind of walked her through this thing. I said, okay, you have all this money in a savings account. How would you feel if you only had X? She goes, that would make me feel uncomfortable. And that X that I threw out was the minimum that I would advise her to keep. And I said, how would you feel if we had X plus 5,000? She goes, maybe a little bit more, but still uneasy. And that was kind of mid range of what I would recommend. And I was kind of working towards like, if you have more than this, I think it's bad finances. So I started incrementally going up a little bit. She goes, yeah, X plus 7,000. She goes, that makes me feel comfortable. I said, okay, cool. Everything above that number, we're putting towards debt, like when you leave here. So it's really important to understand, like there was a range of advice that I would have given. So yeah, understanding people's emotions is incredibly important because people are going to follow my advice when it they feel good about it. That's it. And that's the problem with traditional financial planning. It's like you're going to pay me a lot of money, and here's your financial plan. It's 150 pages long. Go execute it. And basically, what just ends up happening is you pissed away $10,000 or $15,000 on a financial plan.
To put it on a shelf and not because you don't relate to whatever's in that because this doesn't feel like it's yours,
I,
right?
oh my
Yeah.
God, I've come across so many of those where it's like, oh, we worked with a financial planner and did it. I'm like, well, that's a problem. That was first of all, it's bad advice.
Yeah.
Sure, they checked all the compliance boxes. Yeah, they protected themselves against a regulator. But at the end of the day, it's what we implement and execute is what's important. That's why, again, like financial planning is done over time. Like people aren't emotionally ready to do all these things at one time. And that's the problem is if you wait to become financially ready, to get your business ready, and to get emotionally ready at the time of sale, it's too late. It's too late. Like
Agreed.
you're either going to sell it when you're not ready or you're going to have to wait another 5 years to get ready. Bottom line.
So let's talk about that. Let's talk about a scenario. I actually just did a workshop in Oklahoma where we spoke to owners in the morning and we spoke to future owners in the afternoon. It was a great workshop. And let's just say a topic came up where there's one owner with multiple children, with one child working inside the agency, but three heirs, if you will. And so this whole idea of waiting too long, that can create a lot of challenges. So let's just talk about the different things to think about because in essence, the child in the agency at some point is building an asset for their parent and then eventually buying this asset. But, it's tough to let go and see that asset as somebody else's when you're the parent. So let's just, I don't want to go too far, but let's just talk about the challenges with that kind of scenario.
So a couple things. Early in my career, a mentor of mine did a lot of business planning. So business succession, key man insurance, split dollar, that kind of stuff. So like I guess I can say I cut my teeth on business succession planning. And we often talked a lot about what we call accidental disinheriting your kids. So, all right, I'm a business owner. I grew this business to a $4 or $5 million agency. My firstborn works in the agency. They're running it. They're operating it. It only makes sense that they take over when I pass away. I've got 2 other kids. So, I'm giving it to my firstborn. Like, oh, wait a minute. They're about to inherit a $5 million asset. What am I going to do for my other 2 kids? Right. Well, I hope you bought a lot of life insurance when you were younger, or you built up enough liquidity to balance the estate. Maybe you don't want to leave them anything. And again, how you distribute your estate is totally discretionary. You don't have to balance it out, but rarely do I find someone who doesn't want to balance out their estate. That's the first problem. Okay. So then, okay, we can solve it by the kid in the business can buy it from me. Well, wait a minute. And I remember having this conversation with an agency owner last year. I said, "Oh my gosh, you're the one driving the value of the agency right now. You're the one who's creating mom and dad started the agency, but you took it from like $500,000 in revenue and built it to $2 million revenue, your own work." Okay. So what you just did was, and it's okay again, but let's kind of go into this eyes wide open, right? What you just did was you created an asset that you just made it more expensive for yourself to buy. Now, wait a minute. Well, that's not fair. Well, again, let's deal with this while everyone's alive and we can actually make decisions now, as opposed to post-mortem, which is very, very, very difficult, because then you have resentment and all the emotions right in. Like, I'm pissed at my sister or my brother because I built this agency up, and now I have to now they didn't do this. They don't deserve it. So like those succession things, especially in father son, father daughter, mother, whatever, parent child relationship, you got to have those conversations early on. Because if it's the intention for child one to inherit the business, I would contend, now this doesn't always make the most tax sense, but we don't always let taxes drive financial decisions. I would contend that while mom and dad are still alive, you find a way to become an owner now of a certain percentage of the business, so that when mom and dad die, my business partner is not someone who's got zero insurance experience that I'm pissed at because they're inheriting an asset that I grew. And now I got to listen to my brother telling me, what color I should paint the walls.
Right. Right. How to run a business he doesn't know anything about.
Exactly.
I mean, the reality is staying too long as an agency owner creates discourse, which is the exact opposite of what you're trying to do among your children, or it could create some really difficult things, especially if there's zero plan. And here's the reality. 81% of my clients have no perpetuation plan written down. Zero. I mean, I know that the agency universe study says that, some high percentage have a perpetuation plan. They're not the people engaging me. So while I've not spoken to 40,000 independent insurance agents, that's how many are out there. I think people have an idea of what they want to do. I don't know that it's written down typically, and I don't know if it's revisited. So that lack of a plan for 8 agencies last year that called me in a panic and said, "Oh goodness, like we've even when you've talked about a plan, but it's not written down and the only thing you have is a will, the will is what you're going to go by." And sadly, it could put owners in place that should not be there. So it's a tricky thing. But so tell me, if I'm an agency owner and I am nearing retirement, let's say I'm 50 or above, let's just say, because, whatever. Actually, if I just own a business, I have employees, and I don't have a plan, what are some things I should be thinking about to make sure from a personal standpoint that I give myself as many options as possible?
Number one, I would say the first, maybe the most important thing, even before like, am I emotionally ready, is there's a reality that I make money because I work in this business and it's supporting my lifestyle. And I'm considering exiting this business. So I have to replace a large, maybe not 100% of it, depending on lifestyle, but I gotta replace a substantial amount of it. How am I going to replace it? Now, the easy answer is, oh, Well, I'm going to sell the business and that'll replace my income. Not too fast. That's not always the case, right? You sell the business, you have a giant taxable gain, right? Giant gain that's taxable. You got to give your share to your state, depending on what state you live in. Hopefully, you don't live in California. You got to give a chunk to the IRS, and then you still may or may not have debt, right? Who wants to retire, exit with still having debt, whether it's a mortgage or business loan, right? So when it's all said and done, you're 2.5, 3, $4 million sale that you think, oh, I got $4 million, I'm going to be fine. All of a sudden, you're in the 2 million or lower range, and $2 million sounds like a big number. But if we were to go ahead and invest it and generate revenue off of it, I mean, you can count on somewhere between 4 to 6% for a long time, especially if you're at 50 or 55 doing it. So 2 million is only going to generate $100,000, give or take. That's not a huge number. So you have to be thinking about replacement income. You have to have already started to build some asset that is going to be generating revenue for you, whether it's an investment account or rental property or something. The time to think about that isn't the 3 hours before a sale.
Definitely. Are you ready? So, am I financially ready is the question, right? So that's number one.
Yeah. And that looks like, where are your investments? You got to think, if you have retirement accounts, you can't access those retirement accounts if you're under 59.5. There's some cases where we can figure it out. But generally speaking, if you're looking to exit before 59.5, we got to make sure we have replaced income. Then we have to consider, right, some of the succession stuff that we talked about. We have to consider insurance, right? That's a big one. It's like, okay, your business is paying your insurance and it costs you $2,000 a month. What?
Yeah. Big deal.
Yeah.
Big deal. Yeah. So what about taxes? Let's talk about that because, not everybody is a C Corp. Not everybody's an S Corp. Some people are LLCs. Some people are partnerships. Knowing what your structure is and what the tax implication will be in that transition is important. And, a while ago, there was advice that was given that people should be a C Corp. And obviously, that's not the advice you're going to get if you're looking to sell your business externally. So talk to me about tax planning.
Yeah. So I would always say this. First of all, you should never make a business decision or a financial decision just because of tax liability. Like, taxes should not be the main factor, right? What's the financial decision, a good business decision that I would make? What are the tax implications? If the tax implications are so heavy to where it makes that a bad business decision, go back to your business decision. But I always say, let's taxes are important, but to me, let's not let that drive our initial decision. All right, now with that, taxes are inevitable. You're gonna have to pay taxes. I'm telling you right now, people, there's no magic bullet. There's no product that you can buy. No trust. Let me rephrase that. There is a way around taxes. Give everything away, and you don't have to pay taxes. Okay. Other than that, if you're not willing to give it all away, and don't look, I've heard some of the craziest ways. Well, if I donate it to this organization, but I'm the trustee, and then I can borrow it and loan it back and buy real. Guys, first of all, if that was legal, the cost of compliance to maintain that structure until the day you die just rendered that not financially feasible. Okay. Mentally get to the point that you're gonna have to pay taxes. Okay. How do we minimize it? How do we plan around it? That's the real question. And that's a really hard question to answer depending on where you are. I was talking to someone the other day who's looking at selling a portion of their business. Okay. They have another business, right? So I'm like, oh, did your other business have any losses this year? Right? Because if your other business had losses, we can offset some of the gain from the sale of your business. No, it didn't. Okay. All right. Do you own real estate? Did you have any real estate losses? Maybe we can offset some gains that way. So One is looking at the entire picture. Do you have carryover losses? I had a client, not an insurance client, but they had, this was a Katrina loss. They had a ton, like 100, and they had a condo investment that lost out. So they had like $250,000 of carryover losses. And I discovered it by like happenstance, looking at the tax return. They had this annuity product. They were trying to get out of it and they had to pay taxes on the annuity. And I'm looking at our tax return. I was like, ooh, we can get out of this annuity right now and offset it with these carryover losses. So her tax liability was next to nothing. So I emailed her CPA. I'm like, hey, am I seeing this right? He's like, yes. I said, this is beautiful. We can offset this income with these, or this gain with this. So it was perfect. So that's one way. The time of year, right? Depending on who you're selling to, maybe you do an installment deal and you structure it over a period of years. Like if you're selling if it's, October, November, December, maybe you do an installments deal over 2 years. At least you can spread that out over 2 years.
Well, the point is you have to have a conversation about it. It's not a like overnight decision. And you have to think about, okay, what are the things I need to weigh? Seek advice. If you haven't looked at your tax structure of your entity for years and years and years and years, and you are approaching a time that you think an internal sale may happen, an external sale may happen, the reality is we all leave our businesses. Like whether we want to or not, it's going to happen. So once you start approaching a time that might happen, give yourself some time. For instance, if you are a C Corp and you want to transition to an S Corp in order to avoid double taxation or minimize that, it is a 5-year look back. So you could create a time frame where you go beyond where you want to spend 5 more years in your business in order to minimize that type of structure. So my point is give yourself the gift of time and start the conversations early. If you now think that there is someone that you could transition internally to, think about what that would look like if it's left in your will versus if you do something today, and how you can prearrange what that should be, recognizing the child who's actually helped build the business, those that need to benefit from the asset. There's no two ways around that, but planning allows you to do that and not leave it up to mourning siblings. Like that's the sad part, that's the reality that happens.
You bring up a good point, and I alluded to this earlier, about a child in the business, somehow, whether it's like an act of donation where mom and dad are just kind of gifting me shares, ownership in the business, and they discount it. The reason why that might not be the best tax play is because your business property passes to your heirs with a stepped up basis. So, for example, if mom and dad put in their probably basis in the business is zero at that point if they've been owning it. So they put $0 because they've taken all the money out. So they die. The business is worth $2 million, and I'm the sole heir, and I inherit it at that point. Well, now I inherit a $2 million asset at $2 million. So if I turn around and sell it the next day, I pay zero in capital gains as long as it's still 2 million, right? But if mom and dad gifted me 50% of the business, and then my siblings own 50, well, 50% of the business, my basis is zero, right? So I inherit the basis when they gift it to me. I take that basis when they gift it to me. But then when they pass away, I'm a third of the business that I inherit. I'll inherit that at a stepped up basis. So $333,000. Yeah, is that right? $333,000.33. I'll inherit at a stepped up basis. So that's something else to consider, that gain, like gifting versus inheriting. The office I sit in, my dad owns this building. He doesn't want to own property anymore. And he's like, just buy it from him. Like, why would I buy it from you? Like, you're going to die sometime in the next 30 years. Why would I buy it? And you have to pay all these taxes on it. And I don't want you to give it to me. I'm like, yeah, I'll take it. Right. But then I'm going to take your basis. So like there's some property that's better to pass through at death, but then you have to consider all the implications of that.
Yeah. You don't want to unintentionally gift somebody something and then have a tax liability at the time of your death that was completely unintentional. So get advice is the question. I mean, if you're listening to this and you're thinking about how to prepare for the next step, typically what happens, Eric, in my world is an agency owner gets a call. The call is too good to be true. The money that's being offered to them, they now start thinking about selling their business. They know that the time is coming, but they're working in their business. They're paying attention. They're not really thinking about tomorrow, because honestly, it's difficult to think about when I'm no longer part of this business that I built. That's a hard thing to wrap your head around, but they do that. And the offer is right here, right now, but they haven't done any of these conversations to say, okay, what do I need to think of from a tax standpoint? What do I need to think of from the readiness of my business to be transferable? What do I need to think of my own financial abilities? But that number sounds really good. They haven't actually backed into what's going in my pocket. They just hear that number. And the mechanism matters, like how you get paid matters. So I would start the conversations early to be informed. So when that time comes, it's way more planful and way more organized. So you don't have regret. I mean, 71% of agencies regret the sale of their business. That's also from SEPA. So that is, you came upon a precipice that says, okay, I have an opportunity, and either I wasn't personally ready emotionally, I wasn't financially ready, or looking back on it, my business really wasn't quite ready. So I sold, in essence, at a discount because I could have maximized that value.
So if you go back and listen to episode 2 of this series, we talk about the mindset of the scratch agency owner. This is another stock in my portfolio. If we operate our agencies that way, now look, there's going to be some variance. I get it, but if in general we operate our businesses as though it's another stock in my portfolio, our business will be close to being ready upon sale, or it'll be easier to get it ready upon sale because we're not using the business as a personal piggy bank. Okay, we're seeing it as a standalone company that we're trying to grow the same way, you would hope the CEO of Apple is trying to grow Apple. Okay, and again, you might not have it all in line, but it's usually a whole lot easier to get your books cleaned if you're kind of operating in that mindset. The emotional ready part, this kind of ties into the financial ready part, particularly when we're talking about family businesses and that transition from a parent to a child. Is the parent's not a financially ready? Okay, part of it is because they never prepared emotionally, just because they didn't want to think about the idea of, I mean, this was their baby, they want to stay around forever. And part of the deal, it's structured in such a way that is like the sweetest possible deal for the original owner, and it really handcuffs the child who's left owning, because the deals typically sound something like this: hey, look, I'll give you the business or whatever, we'll just kind of whatever, we'll find a way, we'll transfer the shares to you, you just pay me $150,000 for the rest of my life. Right? Well, oh, yeah, that sounds like a good deal, right? The business is cash flowing a few million, why not? Right? But like, how long is dad or mom going to live for? Like, how long are you paying 150,000? What happens if, okay, here, take this one for being emotionally ready. Okay, we do that deal. It's cool. I can cash flow $150,000. That's not a big deal, right? If the business is generating 2, 3, 4 million, I'm growing it. It's not that hard. I get 10 years out, dad's still alive, and I'm done. Like, I'm done operating agency. So now I'm ready to sell. Holy crap. Now I have to deal with the emotional transition of me stepping out and the fact that I'm about to cut off my 85-year-old parent from their main source of income.
Oh, yeah.
So let me,
And it's a real thing,
yeah.
Eric. I mean, I've seen a fair number of agencies that are at retirement age still paying an annuity, in essence, to their parent who's still living. And my question is, thinking back to episode number 2, that's an expense that could have been invested inside the agency after a reasonable amount of time that the agency was purchased for a reasonable amount. No one has a clue how long people are going to live. So what sounds like a really good idea, it minimized the tax, it created a nice retirement, but in essence you probably overpaid and you probably were not able to invest in growth. So now the current agency owner's retirement is different. And if the annuity is, if the agreement is you have to continue the annuity, there's a liability going along with this agency in order to sell the agency. It's a tricky place to be.
And what
It
does that
really
do? What does
is.
that do to my EBITDA when I have a giant salary
Exactly.
to a person who is no longer contributing to the business 10 years later?
Yeah. Yeah. The opportunity cost of that after a period of time. Listen, everyone should pay what the value is over. I'm not suggesting that, but when it lasts beyond that, it really could have been another two producers. It could have been whatever, which would have created growth and value and all kinds of things that again, understand the decision you're making and understand the agreements that you're signing and the options that are available for people. Because unfortunately, you could make what seems like the best decision and it could end up really changing your own retirement and potentially the next generation's ability to continue that,
This
So,
is one of the reasons why, and I tell my clients is I am unapologetically going to push you to save way beyond your comfort. You can always save less, but I will unapologetically push you to save, 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 build liquidity. Um, this is one of the reasons because I could say in theory, okay, look, I'm gonna live frugally, and then I'm gonna sell my business, and then I'm gonna invest it, and then I'll have enough to live on. Okay, well, I mean, we've seen these transactions happen, and like that's theory, that's hypothetical. There's no guarantee. Look, the past 3 or 4 years, we've seen some bananas numbers with valuations. Who's to say when you're ready to walk away that that even today, as we record this, valuations have come down tremendously. Who's to say that when I decide to walk away, that valuations will be that strong? No one. Well, I can wait
yeah,
to
there's
sell.
no crystal
Yeah,
ball.
I can
There's no
wait to
crystal
sell. No,
ball.
you're gonna get to a point where it's like when you're ready, you're like if you're ready to walk away, you're not gonna want to wait. Like I'm done. Like I'm done. So like my mentality. Here's what I'm doing. My mentality is whenever I take a distribution from the business, it's profit. It's not part of my income, right? I have multiple streams of income. The majority of my income is provided by my financial planning business. Anytime I make a distribution, I take not 100% of it, but a large majority of it, and I throw it into my work optional account. My work optional account is an investment account, and I've got a target. And one day it's going to hit that target, and I'm going to be less emotionally tied to my business because I've got enough to replace that income, and it's going to make it easier for me to walk away when I want to.
Yep.
Not if,
It
but
creates
when.
options.
When.
Yeah, it creates options. No question about it. You got to create options. No two ways around it. Erica, we could talk about this.
All day.
We could talk about this all day long for sure. I am so appreciative to you for what you do for independent agents, what you do to help them plan through this and have a trusted person that they can bounce ideas off of and seek guidance. And I hope that we've changed the perception of what getting financial advice looks like, because it isn't just what should I invest, it's really what should I consider and who should I surround myself with when I'm trying to make these decisions all throughout the life cycle of our adult years, as an agency owner. So I really
A
appreciate
big
you
part of
doing
it too.
this.
Let me just add this. Your financial planner, um, you as the agency owner, you don't have to become an expert in anything other than running your business. Me as a financial planner, I am not a CPA. I understand taxes pretty good. I'm not an attorney, but I understand different business structures and trusts and whatnot. What I do know is I know how to have the conversations with CPAs. I know how to have the conversations with attorneys. I know how to have the conversations with you as a CFO. I know how to read balance sheets. I know how to read income statements. I can look at a tax return. So a financial planner sometimes is sitting between you and your other professionals to help communicate what you don't know how to communicate to them. Not because you don't understand, because that's not what you went to school for. That's not what you get paid to do. And that's a lot of times, that's actually part of my favorite part of the work, is having conversations with your CPA and with your attorney.
Not only that, Eric, you have an understanding of both sides. Like, you understand what it's like to run this agency, and you also understand what you need in order to plan, which makes you very unique to be able to have those conversations. So I really appreciate you coming on. I'm sure you will be a future guest. There's no question around that, because we got all kinds of things to talk about. But again, if someone just tuned in, number one, you missed 2 other episodes that you should rewind and go back to those as well and pay attention to them. But if someone wants to reach out to you, tell them how to do it, Eric.
Yeah, you can find me at plan-wisely.com, and you can find all my contact information there.
Fantastic. Well, thank you so much for being our guest.
Thanks, y'all. Appreciate it.
Thanks so much for tuning in to the Insurance Refocused podcast. If you enjoyed the episode, please be sure to hit subscribe and leave us a review so you'll never miss us. Want to learn more about how Agency Focus can help you grow your agency? Head to agency-focus.com or email Carey directly at carey@agency-focus.com. If you need to get in touch with me, feel free to shoot me an email at lindsay@agency-focus.com. Thanks so much for tuning in. We'll see you next week.